in the previous class, we have mainly focused on learning cost of debt and cost of preference shares. So obviously, in this class, your focus point is going to be this, that is cost of equity. When we talk about cost of equity, this is not going to be an easy task. It's little complicated. Some students who have already seen the formulas of determining cost of equity, they would not agree with me. They would argue with me. They would tell me, sir, what are you saying? Actually, the easiest formula what we find in the book is the cost of equity formula, just small formulas. It is not about calculation which is complicated, it is the concept which is complicated. And I don't mean that it is difficult as a student for examination viewpoint. I am talking about real life scenario. Determining cost of equity is not an easy task for the company, and there is obviously a reason for that. Just imagine debt. When you are raising funds through debt, it is so simple to determine cost of debt because you know what you are paying, and what you are paying becomes your cost. Same way, determining cost of preference shares, even though preference shares are basically part of the shareholders' funds, so what you are paying to preference shareholders is a definite amount. So how much cost you are incurring can be known. Now try to understand with respect to equity, whatever is the residuary interest in the company, whatever is left over, that belongs to equity. So equity itself means an instrument that provides the holder residuary interest in the company. So how much cost you are incurring towards equity cannot be so easily determined logically because you don't have a definite commitment towards equity shareholders. So what is company's commitment towards an equity shareholder? It could be a similar kind of commitment that I have for you. Just understand one perspective very clearly. Debenture holders are considered as outsiders because they have lent their money and they would claim interest on that. Whether company is making profit or not, company has to pay interest on that. Debenture holders are outsiders. Equity shareholders are not outsiders. They are the owners of the company. So what happens? Just imagine the kind of relationship you people have with me. You come to me with some expectation. I can behave in two different ways. Number one, that boss, my task is to discuss concepts. Now whether you understand or not is up to you. That is one way I can behave. Another way I can behave is, no, these are my students. They have come to me with an expectation of learning. Fulfilling their expectation is my responsibility. When I behave in this secondary type of way, that taking your expectation as my obligation, I would have a relationship where you would be just like an equity to me, as if my own people, not outsiders. So I don't consider you people as my outsiders. I consider you as part of my equity. When I'm discussing concepts, for me, you are as good as equity. What do I mean is, whatever be your expectation, you have X, Y, Z, any degree of expectation about learning finance, I have that as a responsibility towards you. In simple words, your expectation becomes my obligation, because to fulfill your expectation is my sole responsibility. If I don't fulfill your expectation, where would be that relationship of equity between you and me? A point to think over, right? Exactly same way, when it is a debenture holder or a preference shareholder, company would give them a fixed amount irrespective of the profit earning of the company. Company would give them a definite amount. But equity shareholders are never been given that definite amount. Whatever is left over as profit balance, it belongs to equity. Therefore, how would a company determine cost of equity becomes a matter of concern. So the idea that we are going to draw, whatever is expected by equity shareholders as a kind of expected rate of return, to provide that rate of return becomes responsibility of the company, becomes obligation of the company, and therefore the expected rate of return for an equity shareholder is the cost of equity for the company. Let me explain it in one single line. Conceptually, if somebody is asking you what is cost of equity, you would simply say whatever equity shareholders expect as a rate of return from the company, for the company, that expectation of equity shareholders becomes cost of equity. For example, if equity shareholders are expecting 20% rate of return, then cost of equity for the company will be 20%. If they are expecting 25% rate of return, cost of equity will be 25%. Whatever they expect becomes cost of equity for the company. So this much is understandable. Where does the complication come up? Here comes the complication. Different equity shareholders in large numbers, do you think they all will have same type of expectation? No, obviously not. These all equity shareholders will have different expectations. Someone would have invested in the company for a shorter term. Someone would have invested in the company for a long term. Someone is interested only in dividends. Someone is interested in the share price growth. Someone is interested in both. Someone is interested in company's business, that is why becoming shareholder. I think you people must have this much understanding that if I purchase equity shares of a company in such a large quantity that I have more than 50% of equity of that company owned by me, that company would become my subsidiary and I will be considered as a parent company or parent entity. So what happens? I establish control over that company. In that case, how much dividend that company is paying on its equity is not of any relevance, but how much that company is earning is of high relevance to me. Think on the other side about a small shareholder who has invested basically to enhance the worth of his or her investment. That person is looking for dividend income and growth in the share price. That person's objective is different. My objective could be different. Your objective could be different. Everyone's objective could be different. Therefore, expectation of different shareholders could be different. So what expectation should you consider while determining this cost of equity? That becomes little complicated, and therefore here we have multiple approaches for defining what could be cost of equity. So let us do one thing. Let us write up some important notes first of all, and then I take the matter ahead. So your attention on screen while I give you these important notes. So let us begin with the notes writing part under the head cost of equity. And do you notice I have written the symbol over here as KE, cost of debt KD, cost of preference shares KP, cost of equity KE. Determining cost of equity is little complicated. This is because equity shareholders are the owners of the company and the company does not have a definite outflow towards equity which can be used for determining cost of equity. Therefore, whatever is the expected rate of return by the equity shareholders will be considered as cost of equity for the company. The complication arises because equity shareholders may have different expectations. Some shareholders expect dividend and growth, whereas some shareholders focus on maximizing the EPS. Let us move ahead and continue writing further. That is why there are 5 different approaches for determining cost of equity. dividend price approach, dividend price plus growth approach, earnings price approach, realized yield approach, and capital asset pricing model. 5 approaches. You should know one thing very well. The fourth approach does not come in your exam. I have mentioned it mainly from the theoretical aspect. I'll definitely explain you someday what is this realized yield approach, but from examination viewpoint that is not important. Other approaches are definitely important. Let us move ahead and write up further. Now, dividend price plus growth approach, the formula over here, KE equals to D1 by P0 plus G, and each variable over here has been defined. KE stands for cost of equity, D1 is the expected dividend receivable by the year end, P0 is the price of equity share prevailing in the market at present, G stands for growth rate. And what I want you people to do is write up all these notations. I have yet to explain this logically to you. You know one thing, that we are not going to simply remember or by heart the formulas. We will understand the derivation of each formula logically. Let us move ahead and write up the formula notations for other approaches as well. That is dividend price approach. Here that growth factor is not considered. All variables otherwise would have same meaning. And then we have earnings price approach, where in place of dividend what we consider as a numerator in this calculation will be the earnings. So we may define a new variable over here, that E1 is the expected EPS by year end. Obviously I have to discuss this entire thing in details, but let us first finish the writing work. Out of the first 3 approaches, it is dividend price plus growth approach that is the most important and most logical and most frequently used approach. Determining KE. I want you people to write this formula. P0 equals to D1 plus P1 upon 1 plus KE. Just write the heading as determining KE and write this formula, P0 equals to D1 plus P1 upon 1 plus KE. And then let me explain you what exactly is this. What you find on screen is a formula. Let me tell you, at this level, intermediate level, and when you come to final CA level, final CMA level, whatever you are pursuing, when you know that this you are learning today and will require application even at later stage, I can give you an assurance. Many final CA and final CMA students struggle to understand this because they have also remembered formula notations, solved questions. What happens? The easiest and shortest thing is remember the formula, make calculations, get the answer, but that doesn't put an end to your learning process. Your learning process requires understanding this logically. Now, if you just visualize this formula, what it is, P0 equals to D1 plus P1 upon 1 plus K. All these symbols you know. P0 stands for the current market price, then D1 is the expected dividend receivable by year end. What is this P1? If P0 is the current market price, P1 would be the price that will be by end of the year, but we cannot know what is that price, so it is our expectation, just our expectation. So D1 and P1 are basically the future amounts. D1 is the expected dividend receivable by year end, and P1 is the expected price of the share prevailing by year end. Not now, year end. Right now what is the price is P0. The symbol used in the denominator, that is KE, which is your expected rate of return. Beta, please understand what I am trying to tell you. Let us also take an example to understand this. Just follow my point. Assume that there is an equity share on which you are expecting a dividend of rupees 50, 50. You are expecting a dividend of rupees 50. Okay? There is a share on which you are expecting a dividend of rupees 50. And the value of the share by end of the year, will become 230. That is what you are expecting. So, by end of the year, you have two expectations, that this share will offer you a dividend of rupees 50 and the value of the share by end of the year will be rupees 230. So, use your brains. 50 and 230 both will be wealth in your hand by end of the year. 50 and 230 both will be wealth in your hand by end of the year, because these are the values that you are expecting by end of the year. I repeat one thing, this is your expectation. Of course, what you are expecting may or may not happen, but anyway, right now there is an expectation. It is an expectation. You are expecting a value of 230 and 50 by end of the year, which would give you aggregate as 280. When you take aggregate 280 as wealth by year end, wealth today at the point of investment is rupees 200. What I am trying to say is 200 is what you are investing today and 280 is what you are expecting to have in hand by end of the year. What would be your overall rate of return? 280 after 1 year and 200 now. Increase in your wealth is by rupees 80. Increase in your wealth is by rupees 80. When you invest rupees 200 and your wealth increases by rupees 80, you only figure out what would be your expected rate of return. Your expected rate of return will be 40%. So, if you are equity shareholder of this company, your expected rate of return being 40%, what fits in this formula is KE is 40%. Now, what I am trying to tell you is logically understandable. So, please do not try to mug up any formula. If you want to understand this formula, consider D1 and P1 both as future cash flows. Why future cash flows? After 1 year, suppose you would want to sell the share, you will be getting cash inflow of 230 as per my example, and the dividend is already a cash income. So, both taken together, 50 plus 230 gives you 280 as cash flow after 1 year. And your expected rate of return, which I have just conveyed to you, KE being 40%. So, what you always do, future cash flow divided by 1 plus I will convert that into present value. So, P0 is nothing but the present value of the future cash flows. And how do you determine the present value? Any future cash flow divided by 1 plus I. Instead of I is what? Expected rate of return. And for an equity shareholder, that expected rate of return is what we call as KE. So, we are replacing, instead of I, we are putting KE over here. So, D1 plus P1 is the amount of future cash flow and 1 plus KE is the factor. So, instead of 1 plus I, we are putting 1 plus KE. So, future cash flow divided by 1 plus expected rate of return will give you what? The present value of your future cash flows. Once again, allow me to summarize this whole matter. So, it is okay to get it reviewed once again, but it is not okay to go ahead with doubts in your mind at this point, because we are trying to logically derive everything. So, once again, please let me explain this. I have given you an example that today there is an equity share, price of which is rupees 200. You just think why someone would be willing to buy an equity share today. Obviously, for two expectations. One, this equity share would provide dividend every year. Second expectation is Today the price of the share is 200, but later on the price of the share will grow, and that growth will also be a benefit. So from the equity shareholders perspective, your expected rate of return would be aggregate of two components. It will be aggregate of two components, one that we call as dividend yield rate and one that we call as growth rate. Now, what would be the dividend yield rate involved in that example that I have just given you? Simple logic is, by investing rupees 200 today, you are expecting a dividend of rupees 50. So dividend yield rate is 50 divided by 200. Any common man can easily understand that by investing 200, if you are getting a dividend of rupees 50, dividend yield rate is 25%. On the other side, if the share is priced rupees 200 today and it is expected that after 1 year it would be having a price of 230, the share is growing from 200 to 230, the growth is by rupees 30. On the base price of 200, if you work out a growth rate or a growth percentage, it will be 30 divided by 200, that would give you 15% rate. Now, if you understand one thing, 25% is the dividend yield rate, means you are earning 25% by way of dividend, and 15% is the growth rate. You just take aggregate of the two and what you will get is the overall expected rate of return. So in this example, 15% is the growth rate, which when added to 25% of dividend yield rate, 25% plus 15% aggregated would make overall expected rate of return for the shareholder as 40%. Let me give you another dimension to get this logic. One more dimension. Just tell me, how much money are you investing today? 200. That is your current investment? Fine. After 1 year, what is your expectation that you will have in hand? After 1 year, you will be having a dividend of rupees 50 and the share whose price is going to get to 230. So what will be your total wealth after 1 year? Today you have invested 200. After 1 year, total wealth in your hand will be 280. So your wealth in 1 year is growing by rupees 80. Convert that rupees 80 in terms of a rate of return as percentage. So by investing 200, if you are expecting to earn rupees 80, what is your rate of return? 40%. When you look at that example from any angle, you would understand logically that yes, the shareholder is having expectation of 40%. Now do one thing. Now apply that 40% as expected rate of return for the equity shareholder, correct? If 40% is the expected rate of return for the equity shareholder, symbolically it becomes KE. Now let us look at the same thing yet from a third dimension. Third dimension. Today you are investing some amount. We don't know how much you are investing, forget it. But we know one thing, that in future after 1 year, you will get a dividend of rupees 50, and when the share is of worth rupees 230, total wealth in your hand will be rupees 50 plus rupees 230, that is rupees 280 after 1 year. This is a future amount, right? Just find the present value. To find a present value, how do you make calculations? Right from the beginning of your syllabus, the first thing you ever learned was time value of money. I am considering time horizon as 1 year. If I am considering time horizon as 1 year, how do you find the present value of an amount that will be obtained by end of the year? That future amount, simply divide by 1 plus I. That is what you have been doing, right? What is I? I is your expected rate of return. So future amount divided by 1 plus I will give you the present value. Here we will not use 1 plus I. In place of I, as a symbol we are using KE. So future amount of cash flow, when you divide it by 1 plus KE, you will get the present value. So P0 in this formula, what you find is nothing but the present value of the future cash flow. Let me show you what exactly I am trying to specify over here. D1 and P1 is what we are considering as future cash flows, and when these future cash flows are divided by 1 plus expected rate of return, that is 1 plus KE. KE is the expected rate of return. So when future cash flow divided by 1 plus expected rate of return, what you will get is the present value of those future cash flows. So let us do one thing, let us write up some variables over here which we will be using ahead. So what I want you to do is write up this formula you have already written, just write up the notations. D1 is the expected dividend receivable by year end. P1 is the expected market price of equity share by year end. So understand one thing, you are standing at the beginning of the year, you will never know what will be the price of equity share by end of the year. So it is just and just your expectation. KE is expected rate of return by equity shareholder, which is also known as equity capitalization rate, or it is also considered as cost of equity for the company. And what is P0? P0 is the current market price of equity share. Let us move ahead and take up one new example, because if I repeatedly talk about the same example, you will also get bored up. Let us read this example. Mr. X is to decide regarding whether he should invest in equity share of NJ Limited. Expected dividend receivable by year end on share of NJ Limited is rupees 45. Expected market price of this equity share by year end is rupees 300. The expected rate of return by Mr. X is 25%. Determine the current market price of equity share. Now, if you can just focus on this example, it is so plain and simple. At end of the year, you are expecting a dividend of rupees 45, and also the price of the share would reach up to 300. So can you understand what would be the total wealth in your hand by end of 1 year? It will be 300 plus 45. So that will be the future value in your hand. You just have to find the present value, and for finding the present value, you must know what is the discounting rate. Discounting rate is nothing but the expected rate of return, and expected rate of return over here is given as 25%. Because this is typically an expected rate of return by an equity shareholder, symbolically we are using the symbol of KE to represent that. Now, I am sure just when I am talking, many of you would have even computed the answer. Let us move ahead and look into what will be the answer for this example. We are simply going to apply this formula. Though we are not going to be dependent on this formula, logically we should understand what is the present value of these future cash flows. But when you are using a formula, don't forget to define these variables. D1 is expected dividend receivable by year end, that is rupees 45. P1 is the expected price of equity share by year end, that is rupees 300. KE is the expected rate of return by the shareholder, that is 0.25, and P0 is the current market price of equity share. When we find that we know what is the value of D1, P1 and KE, we can easily determine the value of P0 simply by substituting the value of these variables in the formula. So future cash flows are 45 plus 300, and the expected rate of return being 25%, future cash flows, when you divide by 1.25, that is 1 plus your expected rate of return, you would obviously get the present value of that future cash flow, and that comes to rupees 276. Let me take you ahead to something very, very important. This is the formula which we have logically understood by far. Mathematically, if I just cross multiply and take 1 plus KE, the denominator in the right hand side, to the left hand side, just by cross multiplication, can we all agree that we would get 1 plus Ke equals to D1 plus P1 divided by P0, and therefore if I would want to find Ke, I just have to now do one more thing. 1 which is appearing in the left hand side, I should bring it to right hand side. So when I drag that 1 from left hand side to right hand side, obviously I will be getting the value of Ke as D1 plus P1 divided by P0. From that whole thing, subtract 1. If you have understood this much very clearly, then if I have to bring that minus 1 which is appearing at the end in the right hand side within the brackets where the denominator is P0, you know what I have to do? I have to write it as P0 upon P0. I am sure this much mathematical equation solving, all of you are good at that, you must understand. So the modified way of rewriting the same thing could be D1 plus P1 minus P0 whole upon P0. It will indeed give you same effect of D1 plus P1 by P0 minus 1. Only and only if you are clear with this point, I can take you to the next step, that logically Ke would be D1 by P0 plus P1 minus P0 by P0. So we have just done a splitting work, D1 by P0 plus P1 minus P0 divided by P0. It is by mathematical notation, it is the same thing. Now I want you to focus on the expression P1 minus P0 divided by P0. Take an example that if currently the share price is 200 and we are expecting the share price to grow to 220 by end of the year, then P0 is 200, P1 is 220. And if I ask you to find growth rate, what you will do? You would say that the share price is growing from 200 to 220. The growth is by rupees 20. By percentage, it would be 20 divided by 200, and that will be 10%. So to compute that 10% growth rate, how did we move ahead? The growth rate can be defined as P1 minus P0 divided by P0. So mathematically, P1 that is 220 minus P0 that is 200, P1 minus P0 will give you the amount of growth, divided by P0 which is the base price will give you the rate of growth. If I substitute the value of G into this last line written in the slide, I will be getting value of Ke as D1 by P0 plus G. We have substituted G in place of P1 minus P0 divided by P0, and finally what we obtained is the formula for Ke using dividend price plus growth approach. Let me take you ahead and show one important thing over here in this formula. D1 by P0, the first segment in the right hand side, this D1 by P0 is what we called as dividend yield rate, if you can remember the earlier explanation, and G is standing for growth rate. So do you identify Ke in this formula is the aggregate of dividend yield rate plus growth rate? This is also something that I would want you to write, that the expected rate of return by equity shareholder is the aggregate of two components. One is the dividend yield rate and one is what we call as growth rate. Let us move ahead and look at one more thing what can be done from this formula. Ke equals to D1 by P0 plus G. If I send G from right hand side back to left hand side, it will become Ke minus G in the left hand side, and what will remain at right hand side will be D1 by P0. In other words, the value of D1 by P0 would be Ke minus G. Now if I want to find the value of P0 again, I would just cross multiply so that P0 equals to D1 upon Ke minus G. Even this formula has been derived through this connection itself, which is again going to be something very, very important. And don't forget, P0 is the formula for the share price. Let us now move ahead and take up a very good example over here so that we can understand the solution of such calculative examples logically as well as through application of different versions of the formula. Now if we read this example, what is given over here? NJ Limited has been showing a consistent growth in the share price as well as dividends in the recent past. Such growth rate is about 10% per annum. Price of this share prevailing today is rupees 200 per share. The company is expected to declare a dividend of rupees 36 by end of the year. You are required to determine the expected rate of return for the shareholder at present. So can you notice one thing? The question is asking you to actually determine what? The expected rate of return for the shareholder at present. That means the question is asking you to determine KE. If you could identify the current market price of the share is already given to you, how much dividend you are expecting, even that is given to you, and the growth in the share price is also given to you. So you can definitely work out what would be KE, that is the expected rate of return for shareholders. But my only concern right now is you should not be dependent on formula. So we will first logically write up the solution for this example, and then we would blend the different versions of formulas also to solve the same. In exams, you would go with any version of formula that you are comfortable with. So let us do one thing. Let us learn how to present the solution of this example over here. So just go ahead and understand the first line. Expected price of the share by year end, that is P1. It is not given to you directly, but growth rate is given and the current market price is given. So 200 is the current market price. On that you are adding 10% growth. So P1 becomes 220. That means you are expecting a share price of 220. So I have told you the meaning of growth rate. So obviously if the share price today is 200 and the growth in the share price is by 10%, what would you expect the share price to be after 1 year? Of course 220, and that is nothing but P1, which is expected share price by year end. Now what about D1, expected dividend receivable by year end? Question has already given you that dividend amount, what is expected. Many a times question may not give you this information and you will have to work it out using the growth rate etc. information given to you. We will deal with those situations also ahead. Now, so expected total wealth of the shareholder by end of the year. So what would be the expected total wealth of the shareholder by end of the year? It will be obviously 220 plus 36, that will be rupees 256. And the shareholder is invested how much today? If the investor makes an investment of rupees 200 today, the total returns in the year is expected to be 256 minus 200, that is rupees 56. And through this you can definitely logically determine the rate of return as 56 divided by 200, that is 28%. Notice one thing, we haven't used any formula over here. We have simply used logics to determine this calculation. There was no formula application over here. But the problem with logic approach is what? It may take so much of writing work, whereas formula application could be really quick. Let me take you ahead and now apply this version of formula to solve the question. So we have already observed that KE can be determined by D1 plus P1 divided by P0 minus 1. And now because you are using a formula, you must define the variables very clearly. So what is D1, what is P1, what is KE? You define each of these including the meaning of P0. Here did you notice one thing, that P0 was already informed and you were supposed to find KE. In this formula any one notation, any one variable will be missing, that is what you will have to find through the other three variables. Now, if KE is to be determined through this information, you simply put up the values, and D1 plus P1 will be 36 plus 220, divide by P0, that is divide by 200. From this whole thing subtract 1. So what you get is 256 divided by 200 minus 1. So do you know 256 by 200 indicates what? If 200 of today is expected to become 256, 1 rupee of today would become 1.28. So 1 rupee of today is becoming 1.28. From that you subtract 1. So from 1.28, when you are subtracting 1, 1 is your payback of initial investment, your return is 0.28. That is why 28% is the expected rate of return. Let us move ahead and solve the same thing by using this formula, that is KE equals to D1 by P0 plus G. Of course, you have to define all the variables. Whenever you are using formula, defining the variables is a compulsion, otherwise you will not be rewarded for the same. I have explained you everything, just have to note down all the calculations. So D1 by P0, that will give you the dividend yield rate. So that is 36 by 200, that will be 0.18 or 18%, and 10% is growth rate. So 18 plus 10 would give you 28% as overall expected rate of return by equity shareholders.